Good morning, everyone. I hope you're having a great day. It is Thursday, April 18th, at 8:31 a.m. I apologize for being a minute late. Weekly retirement, as always. Friendly reminder, I appreciate anyone who shows up live or watches this at a later time. You are more than welcome. Actually, I encourage and appreciate those who come on live and ask me questions in the chat so that I can answer your questions and thoughts directly and address them directly. If I don't get questions or direct comments from people who are here live, I will read some retirement planning material or websites or articles, whatever it is, to one, try to provide value, but also try to prompt some questions or thoughts from the audience. I also appreciate those who watch this at a later date. I do try to download it, edit it, and post it on my other platforms as well. So if you do have any questions on this material, please reach out to me directly or comment on the video or podcast you listen to, and I will try to do my best to answer them. Or if you have a request for future Money Not Math or retirement planning coffee talk topics, I am more than happy to cover those. Like I said, my favorite thing is to address what's on your mind, not what's on the mind of the internet. Okay, so weekly retirement planning coffee talks are an informal way for me to have conversations and answer questions with people, even if they are not my clients, for free. You're welcome to join the Facebook Live here or stop by my office for free coffee. My office is downtown Thief River Falls, across from Styles by Amy, in the same building as Sarah Jane Boutique. There's no pressure to work with me or become my client by stopping by in person or online. It is my mission to provide the highest quality advice and service possible to my clients. Therefore, I limit myself to only having 100 or less active clients at all times that I have a fiduciary responsibility to. Even though I limit myself to only working with 100 clients at any given time, it is still important to me to provide as much value as I can to as many good people as possible, which is why these conversations are so important to me. Disclaimer: this content is not legal, tax, or investment advice. You should always consult a qualified professional regarding your personal situation. And this is a live video, so I may make a mistake from time to time. So even though I have the licensing in place to give legal advice or financial advice, this is a live video, and we haven't sat down and talked about your personal situation, so it's not official advice. We actually have to be, meeting and signing contracts and things like that for me to give you financial advice and be your fiduciary advisor. I look forward to some great conversations and hope you have a wonderful day, no matter what, whether you're watching it now or in the future. With that, are there any questions to start? Please put them in the comments section now or at any time during this live video. I have 1 hour set aside on my calendar to answer questions, but if there are not enough to take up an hour, I will wrap this up in about 30 minutes. So that'd be about 9 a.m. So we got a couple people on here, so I'll just give you a moment to ask any questions if you have them. And while you are thinking about it, I will pull up some articles in case no questions are asked. Seeing none, I'm going to cover a quick article from morningstar.com, and I will post it in the comments in case you'd like to look at it more closely. It is titled, "What to Know About Recharacterizing Your IRA Contributions." And it has to do with, you can switch your traditional or Roth contribution, but critical rules apply. And this is important for those who are doing some tax planning, whether it's for your future tax planning or current tax planning in retirement. You can do Roth conversions, meaning you can turn IRA contributed money or tax deferred money into after-tax money, and there are different rules around that, and there's different advantages to that as well. So you have two options for making a regular contribution to an IRA: a traditional and a Roth. Whichever option you choose, your contribution must be made by your tax filing due date. Extensions do not apply. However, you get an extension if you want to switch from one option to the other. This switch, or recharacterization to use the proper term, must be completed by your tax filing due date plus extensions. If you want to recharacterize your IRA contribution, consider the following rules. First, who can make the switch? Basically, anyone can recharacterize a Roth IRA contribution to a traditional IRA contribution. To recharacterize, the individual must have eligible compensation. Contributions for 2023 are limited to the lesser of 100% of eligible compensation, or $6,500. An individual who is at least age 50 by the end of the year is eligible to make a catch-up contribution of up to $1,000. However, only individual whose modified adjusted gross income does not exceed the applicable limit may recharacterize a traditional IRA contribution as a Roth IRA contribution. So basically, what they're saying is anyone can move their money from Roth, which is after tax, to traditional, which is pre-tax, but only people making under a certain income limit can go from traditional tax deferred to Roth after tax, which is a valuable point because it just goes to show that our government doesn't want too much money in after tax states. They'd rather have more money in tax deferred states so that in the future, if they decide to raise taxes, they get more of your retirement money without you having any say about it. So, with that in mind, currently the maximum adjusted gross income to contribute to a Roth IRA, if you are a individual, is $138,000 or less. If to do 100%, or $150,000 or more to do none. If you are married filing jointly, you can make $218,000 or less to make Roth contributions, or it's at 100% or $228,000 or more, and you can't make any Roth contributions. So basically, if you and your spouse make $228,000, the government says you make too much money to make a Roth contribution. All right, so with that, I'm not going to go into a bunch of great detail. The link is in the article, but I think it's important to understand that Roth conversions, I don't think I've ever done a Roth to traditional conversion. I don't think I've ever helped someone take their money from after-tax status to pre-tax status. But we have done plenty of Roth conversions from a pre-tax account to an after-tax account with the intention of, hey, let's get our money off the radar screen of the IRS. Let's pay our taxes today so we don't have to worry about what they might be in the future. And the reason why that might be important is, one, if you believe your tax rate will be higher in the future due to your income changes or the government's tax bracket changes, which our current tax laws will sunset 2026, and everything's going to go up automatically by 2-3%. Second reason would be if you don't want to have to be worried about required minimum distributions, that will force you to take money on tax deferred money, whether you want it or not in retirement. The third thing is your tax deferred or money today will count as income tax, will be income tax in retirement, which will affect your Social Security taxes and Medicare costs. So there's kind of a list of multiple reasons why people sometimes do Roth conversions. It all depends on your personal situation. So hopefully that's helpful. If you have any questions, please put them in the chat. Not seeing any. I will try to pull up another article here that hopefully brings you value. Oh, I wanted to mention one thing as well. So I know a lot of people are really excited about, high interest savings accounts. And so one thing that is new for us, one of our platforms that we use two different platforms to invest our clients' money. One is called Altruist, and that's kind of the state-of-the-art technology, advanced technology side of things. Super simple. You have an app on your phone. It's like depositing and withdrawing money just like you use at a bank. Super, really user-friendly. We now have what's called Altruist Cash, and our clients can earn up to 5.1% interest on their cash within their account with up to $1 million of FDIC insurance coverage. So that's, pretty significant compared to, I don't know what interest rate you're getting at your local bank or even maybe your credit union, but 5.1% with no risk is pretty decent if you're talking about just your liquid cash. So that's an option that we can now offer. The other platform that we use is Charles Schwab, and that is more traditional from an investment standpoint, but it does allow us to do more specific things when it comes to investing in gold and structured notes and structured ETFs and things like that. So a couple things to be aware of as far as what we can offer. Again, if that's not something you're interested in, that's totally fine. If you have questions, you can absolutely reach out and let me know what your questions are on that. All right, so here is an article written by Dimensional, and it's titled, "What is Baked into Your Credit Exposure?" I think credit and credit scores is one of the most interesting parts of our financial landscape. On one end, you can make $300,000 a year and never have a credit card open, but therefore you have no credit and the bank might not borrow you money. Or on the other end, you can make $50,000 a year, have $20,000 of debt and credit debt, but you have a great credit score because you've always been paying it off, right? So it's an interesting thing, but here's the article written by Christy Higgins, investment strategist at Dimensional, and it's titled, "What's Baked into Your Credit Exposure?" Again, I will put it in the comments in case someone would like to access it, and it is on Dimensional, so if you aren't able to download a copy or access it, just reach out and let me know. I can download a copy and send it to you. Here's what it says. It said corporate bond funds have been strong inflows to start the year. As investors select funds with credit exposure, they should be aware of what's baked into a manager's approach or not. Oh, so he's talking, okay. Baking is not set it and forget it process. While you start the suggested bake time, monitoring it is important. Oh, this is not all what I was thinking. Okay, they're talking more about bonds. I apologize. This is like investment grade bonds and things like that. If you're really interested in talking about investment grade bond and high yield bonds, that article might be valuable for you. I thought we were talking about credit scores when I saw that link, so I am not going to go into that great detail. But if that's something you're interested in, go for it. So here's the most recent newsletter sent out by Ross Welty, my business partner, and it says a pricing mind trick that can fool any of us. And this is something that I can't include a link, but if you're interested in joining our newsletter that gets sent out on pretty much a weekly basis with a lot of really valuable information. Again, no pressure to work with us just because you're in our newsletter. Just reach out and let me know, and I can get you added. It says, let's do a little make-believe shopping. Say we're looking to buy the latest tech gadget, and it's $500 when we first price it out. A week later, we see it marked at $750 at another store. What do you think when you see that second price? You're probably thinking that gadget is more expensive and that $500 was a great deal. Now, what if I told you that 2 weeks ago, the gadget was just $350? Would $500 seem like a great deal now? It wouldn't, because we're no longer fixated on that $500 price point. Instead, we'd anchor to that first price of $350 and we'd see $500 as more expensive. That's just one way the anchoring bias can skew our perspective. It's also not the only bias we can be vulnerable to when it's time to spend, invest, or make other money moves. So that's a really good, it's one of the many examples about bias. I know we've covered those multiple times in the past, so I'm not going to go through the 5 different biases on this one. In fact, my episode last week, I listed out the 5 different types and asked which one you guys thought was most prevalent. But I see this all the time, whether it's the stock market, people are like, oh, it's super low right now, I got to get in, or it's super high right now, I got to get in, which is the opposite of what we should be doing. Buying a plane ticket, you ever searched a flight to go whatever company to whatever place, and it says $200 today, and then you search it 10 minutes from now, it says $220, you're like, oh crap, it's going up, I better buy it before it goes up even more. And then you search it the next day from a different browser where they don't know you're still searching it again, it's like $150. That's an example of them basically intentionally utilizing the anchor bias to try to get you to feel pressure to buy quickly. So, interesting thought there. All right, so any questions, thoughts, comments, concerns? We're at 8:44. So like I said, I'm happy to stay on until 9:30 if I have questions or thoughts to address. Otherwise, I will just keep covering some online links here until 9, and then I'll wrap it up because I don't want to waste anyone's time. My goal is to provide value. So here's an article, since I don't see any comments, here's an article written by Dan Kemp on Morningstar.com, and it says, Markets Brief, Will the New Inflation Story Hurt Stocks? So I don't know how many people are familiar with how inflation works and how it changes from a year-to-year basis based on economic factors, or how it may or may not affect the stock market, but here's some insights into key market performance and economic trends from Dan Kemp, Morningstar's Global Chief Research and Investment Officer. You know what? It is retirement planning coffee talk, and I'm not even sure where I put my coffee. Sorry about that. I'm really thirsty, and apparently I forgot my coffee out in the car, so I guess I'll just have to have a nice caffeinated beverage. All right. Here's what Dan says. The 2 latest inflation data captured investor attention last week. And this was written, just so we're all on the same page, April 15th, so pretty recent. He said core consumer prices, which exclude the volatile costs of food and energy, rose 3.5% over the previous 12 months, compared to 3.2% last month and the expected 3.4%. The threat of inflation persisting challenges the narrative of lower inflation leading to lower interest rates. The concern this has raised among investors likely contributed to the Morningstar United States Market Index falling 1.63% over the week. Investors now expect fewer rate cuts, right? So if you go back like 6 to 8 months ago, we all thought there was going to be 3 to 4 federal rate cuts this year, making it, easier to get lower interest rate loans. Now, because inflation has come down pretty decent on its own. The Fed is now backing off from that story of having 3 to 4. And they're talking about having fewer. He's saying the probability of at least 3 interest rate cuts this year has fallen to 28% from 68% a month ago. That's a massive drop. Pessimism around inflation can also be seen in the bond market, with the 10-year U.S. Treasury yielding 4.52%. While lower than its peak in the fourth quarter of 2023, it is significantly higher than the year-end yield of 3.87. So that's basically you couldn't buy a bond from the U.S. Treasury and it's going to pay you less than just putting it in cash through our altruist accounts, right? So it's pretty interesting how dramatically the bond markets changed in just 12 months. Big banks are causing a stir. Financial companies were in the spotlight as they reported their latest results, and the reaction to J.P. Morgan Chase (JPM) was notable. Against a background of weakening sentiment, investors appeared to ignore the strength of its business over the first quarter and express their displeasure with the bank's neutral outlook. Despite its stock price falling 6.47% on Friday, Morningstar banking analyst, I can't say that name, something Sharma, believes JP Morgan is still overvalued. Citigroup, C, and Wells Fargo also shared their quarterly scorecards last week. Neither suffered the declines. JP Morgan did, reminding us that disappointment is often most felt where expectations are highest. Consequently, periods of negative sentiment create opportunities for long-term investors to buy high-quality business at attractive prices. That's a really good example of two things. First, if you have too high of expectations, it's much easier to get disappointed. So let's try to be realistic. I'd rather undercommit and overperform than overcommit and underperform. Second, it's really important for us to understand that in times of need or in times of negative hysteria in the market, in the news, in market dips, that's really where a lot of opportunity comes for those of us who are trying to create long-term wealth, as long as you are liquid and you are calm and you have take advantage of opportunities that you see come about. All right, so sticky inflation, weaker stocks, question mark. While there are few significant economic releases this week, market commentators will likely seek confirmation of the new narrative that inflation is stickier than previously thought and that interest rates will thus be higher for longer. It is a short logical leap from there to the belief that the economy will slow and profits will be harder to come by. While the data will ultimately reveal the perspicacity? I'm not sure what that means. Anyone know what that means? I'm gonna look it up. Perspicacity, the quality of having a ready insight into things or shrewdness. Wow. Learning new words and fumbling my language in front of everyone. That's perfect. Words are hard sometimes. Of this narrative, it may be tempting enough to cause further price falls. Robust estimates of the fair values of the investments that interest you are essential if you want to respond well in these situations. Without the research required to anchor your decision making, it's better to stay invested and focus on the benefits of participating in the long-term growth of equities. So, he's going to go more specific on what stocks are up, what stocks are down. I'm not going to go over that because I don't believe in intentionally picking individual stocks. So, here are highlights of this week's market investing events. Monday, April 15th, the March retail sales were up 0.35% versus 0.6% in February. Tuesday, April 16th. Okay, I don't care about these individuals. Stats for trading weekend, April 12th. The Morningstar U.S. Market Index fell 1.65%. The best performing sectors were technology down 0.48%, communication services down 1.1%. So basically the entire market's going down and the best performing were just down less. The worst performing sector was financial services, down 3.59%. Yields in the 10-year U.S. Treasury notes rose 4.5% from 4.39%. West Texas intermediate crude prices fell 2.5% to $85 per barrel, which could mean that our gas prices might be going down soon. Of the 704 U.S. listed companies covered by the Morningstar, 82 or 12% were up, 2 were unchanged, and 620 or 88% were down. So that basically 88% of the market was down, 12% was up. Which is another valuable reason of diversification is huge, especially if you don't want massive volatility in short term. So questions or thoughts on that article and how inflation may or may not hurt stocks? As we can see right now, we don't really know what's causing the market to go down a little bit. Maybe it's because the Fed's not going to lower. Maybe it's because inflation's going down. Maybe it's completely something else. But what we have to understand is a lot of these companies aren't going to stop trying to make money. and a lot of Wall Street has already baked all this stuff in, so reacting to what's already happened is not a good idea. All right, so here's an article by Morningstar Digest. As you can, I'm a big fan of Morningstar. I believe it's one of the better free financial websites when it comes to investments and stocks and things like that. With the caveat of understanding, they're still writing articles to sell ads. So to get you to click what I'm doing right now, they're not writing an article to you, the individual, to help you get perfect financial plans, right? That's where, of course, I'm biased, but I believe having someone you trust helping you build a plan built for you is better than the DIY method of just reading an article and hoping it applies to your situation. So these are very broad. I'm trying to create conversation. I am not using these articles as direct advice to your situation. Here's an article written by Sarah Hansen, and it's titled Magnificent No More, Apple and Tesla stocks are weighing on the market, and why growth concerns are affecting the stock prices of these two investor favorites. I think this is intriguing because I think everyone in the world, at least in America, have probably heard of Tesla and Apple. I know Elon Musk and his purchase of Twitter, now called X, has been definitely in the spotlight a lot recently. She goes on to say, Apple and Tesla have gone from stock market darlings to dregs. I think this article is going to be a really good example of why we shouldn't hook too much of our retirement portfolio on the back of like 1 or 2 or 10 companies, because even though they can absolutely explode and do fantastic for you, they can also do the opposite. All right, so Apple's stock price is down 9% this year after roughly 50% returns in 2023, while Tesla's stock has plunged nearly 30% after returning more than 100% the prior year. These two companies, which are among the most widely held stocks, suffer a similar ailment, slowing prospects for growth. And I'm a big believer that, and this is where there's more, the smaller a company is, the more opportunity for growth there is, but there's also more opportunity to go to zero or more potential, which is why there's a little more risk and reward tied in. Whereas the bigger a company gets, the harder it is to keep expanding at a really quick rate. You kind of have a leveling off period and you become more of a consistent grower. So it's important to understand that just because, and I know I talked about this, I believe a few weeks ago, just because a stock or a group of stocks has done phenomenal the last 10 years, it doesn't mean they're going to do phenomenal the next 10. And in fact, a lot of research out there shows that if the top 10 stocks the last 10 years likely won't be the top 10 stocks in the next 10 years, just because of how markets are cyclical, economies change, technology changes, and at a certain point, growth potential decreases. All right, so that means the Magnificent Seven, a group of mega-sized tech stocks comprising of NVIDIA, Tesla, Meta Platforms, Apple, Amazon.com, Microsoft, and Alphabet, which is Google, are no longer moving in lockstep. It's a major turnaround for two tech icons that have played key roles in propelling overall stock market indexes higher. Instead, as the stock market has pushed to new highs, leadership has fallen to stocks central to the artificial intelligence boom, such as NVIDIA and Microsoft. But for Jeff Schultz, the head of economic and market strategy at ClearBridge Investments, this divergence is positive for stocks overall. He says, if everybody's not piling into these perceived bulletproof leaders and rotating into other areas that have lagged, that's a really good sign of the soft landing materializing and broader earnings recovery, he says. So basically, what I just took from that is it's a good thing to diversify out, right? And if you look, they have a little thing on the side here. Apparently, Tesla is down 3.55% today, and Microsoft's down, Alphabet's down, NVIDIA's up 0.33%, Amazon's down, Meta's up 2%, and Apple's down. So of the big seven that everyone basically was obsessed about last year and the last few years, all but basically 2 of them are down right now. So Apple, going back to the article, Apple and Tesla underperformed in the first quarter. Apple, which accounts for 5% of the portfolio weight of the Morningstar United States Market Index, was responsible for roughly 7% drag on the index's 10.2% total return in the first quarter. Electric car maker Tesla is less heavily weighted in the index at a little under 1%, but the firm also accounted for 4% of its losses. Meanwhile, the other members of the Magnificent Seven continued to soar despite the threat of high interest rates thanks to stubbornly high inflation. AI behemoth NVIDIA was responsible for 21% of the U.S. market's 10.2% overall gains, while Microsoft accounted for 7%. Amazon and Meta accounted for 6% each, while Alphabet trailed slightly at 2%. Why is Apple stock down? Morningstar equity analyst William Kerwin points to three factors pressuring Apple stock. First, the company is facing headwinds from slowing growth and declining sales. That's really centered on the iPhone, which continues to drive the business, Kerwin says. He points specifically to competition in China, where domestic and more affordable alternatives are eating away at Apple's market share. Last month, a report from Counterpoint Research indicating iPhone sales in China were down 24%, made headlines and sent the stock falling. Globally, slowing product refresh cycles, how often consumers buy new iPhones, are also slowing down, which I think I can relate to. I actually stopped buying Apple because one, you can pretty much get the exact same technology in a Google Pixel for like 60% of the price. And second, they kept stopping to work. So it was forcing me to get new ones when I didn't even want to get new ones. I wonder if that's intentional. But second, in the article, Apple is facing regulatory scrutiny in the European Union as well as the United States. Kerwin doesn't see this as a major fundamental headwind, but investors are still reacting to negative headlines. Third, there's the factor that's propelled other members of the Magnificent Seven higher: AI. While Nvidia, Meta, and Microsoft have seen their shares soar on the new AI initiatives, there's been negative sentiment that Apple has not announced anything, Kerwin says. Analysts speculate that an AI announcement could come at Apple's Worldwide Developers Conference this summer. So, Apple's prospects. Morningstar analysts still see Apple stock as fairly valued after spending much of 2023 in overvalued territory. The stock is trading in the $170 range, so you can buy one stock of Apple for $170, compared with Morningstar's fair value estimate of $160 per share. We expect it to be a mild to down year for Apple, Kerwin says. He says a major AI announcement this summer or a return to growth for the iPhone later this year or in 2025 could spur a rally. So why is Tesla stock down? Tesla's shares have seen even more dramatic losses this year. Morningstar equity strategist Seth Goldstein says the company's slowing delivery growth is contributing to that slide. The carmaker reported its first negative quarterly delivery number in 4 years this month, a drop that was significantly worse than investors expected. In a press release, the company attributed that slowdown to preparation ahead of production of its updated Model 3, as well as shutdowns at its Berlin factory in the wake of the conflict in the Red Sea and an arson attack. Tesla is a high growth stock, which means slowing growth assumptions can have an outsized impact on its price. All right, so kind of interesting, a lot more in depth on two companies than I would normally go, but they're two of the most well-known companies in the world, so I thought it might be valuable. Plus, I enjoy studying the economics behind why things happen. So it is fascinating to see that even big, giants like Apple, who people think are super secure, either can have negative outcomes when the rest of the market's up, right? The whole market's been up this year to a certain, and especially in the first quarter, and yet these two companies are down. So just because a company is extremely well established, it doesn't mean it's safe, right? At one point, Blockbuster was established. See you later. The BlackBerry was established. Here comes Apple, right? If Apple doesn't catch up on this AI train, who knows? Maybe 5-10 years from now, we aren't even talking about Apple iPhones anymore. We're talking about something new. And what we used to think was, and I'm not saying it will happen, but what we used to think was the most secure and powerful phone company in the world, maybe it's gone. Who knows, right? The point is, it's really important to, one, have a plan for your retirement planning, but two, make sure that you diversify out. REX is the stock that I think everyone should buy, huh? I'm curious. I'm not even sure what that ticker stands for. I'll look it up. There's only one stock to buy, REX, someone points. Real Brokerage Inc. Can you tell me why that is the only stock anyone should buy? I'm curious. 52-week high, 4.58. 52-week low, 1.09. So it's kind of in the middle of its high and its low. I do not know how to I'm not sure that's a comment, not a question, but I'm curious your reasoning for that's the only stock to buy. If you want to comment further, I'd be really curious. Someone said the only stock we should buy is the Real Brokerage Inc., REAX. I'm guessing it's a real estate services and real estate. So I know the person who made the comment works in real estate. Huge upside potential, fastest growing brokerage in the United States. I'm curious. That's interesting to consider. That's fair. I think it's what's fastest growing today may not be fastest growing in a year, but it's definitely something worth considering for someone who's, at least the price is low enough that if you're going to take a flyer, you don't have to go broke. Like one share of Apple is $170. One share of REAX is $3. It's a little more reasonable if you're going to take a flyer. Overall, when it comes to retirement planning, I do not believe in picking individual stocks. However, if you want to take a portion of your assets and play in the market a little bit and pick individual stocks, by all means, go for it. It just makes sure you're saving a majority of your money in other places where it's not so heavily dependent on one company, is my personal belief. Um, so, any other questions, thoughts, comments, concerns? Out of curiosity, the person who commented, is that where you work? Is that brokerage you work for or with? Good insight. Thank you. Appreciate that. I do my best. It's my job. It's my goal. We're not perfect. We don't do everything that not everyone agrees with what we do, but that's why there's different options out there for different types of people. So, does anyone have any other questions, thoughts, comments, concerns about anything retirement planning related? So, this is not retirement planning related, but I'm a big believer in personal self-development, and I try to take 10 minutes a day plus to do that. I read at least a few pages of a book, and try to read different things. One thing I absolutely love, and I'm gonna promote it because I believe in it, and I think it's awesome that he does this weekly, is for those who don't know, Shane Zutz, formerly the principal of Lincoln High School, now works at DigiKey as, I think, one of their vice presidents of HR. I don't know his official title. He sends out a weekly leadership newsletter. So, like I said earlier, we have a retirement planning newsletter that we do. If you want to get on that, provide your email. I'd be happy to add you to it. No pressure to be our client. I think it's just really great free information. Shane does a leadership weekly newsletter that I really enjoy. And he's got a bunch of links that you can do a deeper dive, but even just the surface level, I think is really valuable. So I'm just going to cover this. If I get any questions regarding retirement planning by the time I'm done, I'll be happy to answer them. Otherwise, I'm going to let this be the last thing that I cover for the day. So he says, High Impact Leadership Instrument Edition. Put your headphones in cover the course of next week, as there are the 3 great pieces of content to listen to this week. Scott Stratton exposes us to you on leadership. For some of you at DigiKey, you may remember a presentation he gave called On Marketing. Lauren Johnson challenges us to think about our Zoom function, and Craig Groeschel talks about I don't think that wording's right. How we are all flying by instruments right now, pilot term, all excellent. He says, we have discussed how fast the world moves for us all personal and professionally. Pilots, I think, call it flying in the soup, when you are in the fog or clouds and have a hard time seeing. Honestly, that is how it seems for leaders often. That we are flying in the soup. And this is really interesting. I haven't read this yet, but I just talked to a business owner yesterday on the golf course, and we were talking about how different it is to manage, own, or run a business. It's not like you can show up and have a plan. It could be for retirement planning too. This analogy carries. You can have a plan all you want, but when you wake up in the morning and actually go run the business or go into your retirement or be exposed to life, things just happen, right? So you're flying through the soup a lot, and you have to wear a lot of different hats, and you got to do a lot of different things, and you got to be really good at reacting, but also maintaining your cool in stressful situations. And that's where one of the most important things you can do, especially when it's retirement planning or running a business or investing, is try to remove the emotion, utilize your logic, and basically just stick to your plan. And that's why I have the written behind me. I know I said it last week, but I think it's worth bearing repeating. The most successful investment accounts are owned by dead people, because dead people don't react to market trends, and they don't react to the news. And let's be honest, everything just sits the way it was. So getting back to the article and getting back to the newsletter, and if you want to be added to his newsletter, again, just shoot me your email and I'll send it to Shane, and I'm sure he'd be happy to add you to it. Groeschel reminds us to monitor our instruments because our emotions tend to lie to us often, just like the clouds or fog may do to a pilot. 100% agree. It is maybe more important than ever to monitor your team and organization that you are leading. So Groeschel shares 3 ways to be more adaptable as a leader and navigate the world you live in as a leader. First, learn to read, interpret, and trust your instruments. How are you using data to inform how you need to change, think, and act? Study the numbers and inputs in front of you will give you the understanding needed to make an impact. 2. Make constant, nonstop small corrections. Based on that data you're seeing, make small adjustments to keep your team heading in the same direction. This is also what Lauren Johnson talks about this week. Small, consistent correction is a sign of great leadership. Third, learn to feel and flow. Avoid overcorrection. You can't obsess over every problem. The goal is to identify and then make those small adjustments. He encourages getting in the flow of making small adjustments. Hit pause, zoom in, and simply wherever you can for your team, keep your instruments in mind. So he's got a bunch of other things you can read or watch. I'm not going to go into each one, of course, and he's got a whole link that you can even read more about everything I just said. That was just the highlights that I think is extremely invaluable. Since I don't see any additional questions or comments, I hope this retirement planning coffee talk was valuable. I'll be posting it on my other platforms. Please reach out with questions, comments, or concerns, or requests for future topics to be discussed. Thanks for those who stopped by live today, and I hope everyone has a great day. Thanks. Bye.